Hey, good morning, everyone. Welcome to the new week. Welcome to the macro snapshot. We are Monday, May the 18th, 2026. Okay, so what we're waking up to, what I want to say is that we're waking up to a world in which the Iran problem has not been resolved. And so just want to immediately look at sort of oil here. So you see that here on the WTI contract, the front contract, which is now June, I believe, it opened up higher, has come down a little bit. But essentially, there were some aggressive tweets by Trump saying that they're going to wipe Iran off the face of the world, et cetera, et cetera. So the market didn't like that and gapped up a little bit higher, but has subsequently given that back. On the other hand, Iran apparently has resubmitted some points for discussion through the Pakistan intermediary, and we don't have the American reaction to that. But the point I'm trying to make here is that if you look at both the WTI contracts and the Brent contract, which is up as well, maybe not quite as much. The issue here is that the oil shock has not gone away, and we see that most clearly if we look at, let's say, something like the RB contract, which is gasoline. You can see that's almost at highs. So this is not really a market which is pricing a reduction in the oil shock. I don't have the charts here for jet fuel or for diesel, but they are also very, very, very elevated. And we had, for just a sort of anecdotal evidence, the chief executive of Ryanair saying that, sort of fuel was becoming a big issue over in Europe. The Ryanair, of course, the budget airline in Europe. We also had the head of the EIA, I believe it was, Biro, basically saying that oil stocks, oil inventories are getting to a very critical point another few weeks, and there's going to be a serious problem. So what's happening here is that in the physical market, the oil market is getting very, very tight. And the reality is that although there are some sort of toing and froing and discussions, the reality is that the Strait of Hormuz is still effectively, kind of 85, 90% closed, and that oil production and refined products, whatever, are not actually getting out. We're still down, sort of 5 to 10 million barrels per day. And this is just taking down inventories. And we could be in a situation in, let's say, 4 to 8 weeks of extreme stress. So the point here is that the oil shock has not gone away. And what's sort of happening is that if we look into sort of the yields, we're starting to get the yields really, really reacting. So let's say if we look at, let's say just a quick look at the yield chart, you can see on Friday here, we had a huge burst up. Let's say it's the 2-year yield now well over 4%, 5-year up as well, the 10-year well above the 4.5%. It's also broken this long-term downtrend here, which is this gray line, given back a little bit this morning. But also the 30-year here getting up towards the 5.15% here. And we see the measured move. It actually got all the way up here into the sort of the Fibonacci extension here, and faced a little bit of resistance at about 5.16. But essentially, the bonds are telling us that that there's a problem here. So the bond market and the rate market is now demanding an energy sort of premium and a fiscal premium. And when I talk about a fiscal premium, just over the weekend we had news. Excuse me, sorry, my throat's a bit dry. We had some headlines out of Italy and Japan, just as an example, of governments saying that, for example, Meloni in Italy saying that maybe the European Union should sort of relax their fiscal rules in order for the government to release a bigger budget, some extra money to help people absorb some of these energy shocks and supply chain shocks. Similar kind of situation in Japan, where they're talking about preparing a supplemental budget to help people as I say, to absorb some of the shocks. So the point is that all around the world here, we have the energy prices going up, pushing up inflation expectations. And we also have the fiscal problem of too much bond issuance and potentially even more bond issuance. We know what's going on in the UK and in terms of that political situation. And then the bond market here is just having a little bit of a tantrum. So really what we've got to look out for today is whether we saw that bleeding into a little bit into equities on Friday. So if we go into equities, well, first of all, let's look at the volatility here. We can see that the VIX was up almost to 19 and a half. So that's starting to put a bit of pressure. We can also see that the MOVE index, and this is something which had been relatively tranquil, but we see the MOVE index, which is the index of bond volatility, that also ripped a lot higher on Friday as well. And the thing is that if you look historically, and I've done some research on this, if you look historically, if growth is regularly sort of solid and the real economy is growing, and bond yields are growing at a sort of for a healthy reason and at a measured pace, then the equity market can normally deal with that. What the equity market does not like is bond yields going up for sort of the unhealthy reasons, for increased inflation expectations, but inflation expectations due to not so much sort of just real sort of economy growth, well, growth in the real growth in the economy, but because of sort of shocks, sort of energy shocks or supply shocks. And also the equity market does not like bond yields which are rising too rapidly. And that's the problem in a disorderly way. So just actually, before we get on to the equities, I just want to look at just sort of a bit of a sort of the macro picture and a bunch of charts just to really show us where we're at. So obviously we've got the nominal yields rising, but also just what I want to show here is, and you see here, let's say a combination here of real yields and inflation expectations. This is which is kind of one way of looking at the nominal yield composition. So we have here the real yields added to the inflation expectations. And you can see here on the 10-year up to about 4.5%. This is from the St. Louis Fed. So if you look here, and we'll also see here the break even. So we've got the 5-year break even rate going up higher. So this is the sort of imputed sort of inflation expectations on the 10-year, similar kind of story. So on the 10-year, you got the inflation expectations break even going up. Now, if you look at the real yield here, you can see the real yield is also ripping higher. So this is the nominal yield subtracting the sort of inflation expectations, or one measure of it, like the TIPS market measure of it. And you can see here that that's ripping almost to above 2%. So what does it mean when you have a real yield which is going higher? That means that is a yield which is a tightening sort of financial conditions. So that means that if you factor in where the 10-year nominal yield is, and then you sort of say, well, okay, is that higher than inflation? The reality is it's over 2 percentage points higher than imputed inflation or expected inflation here. And this is tightening financial conditions. And if this goes higher and higher, that is not great for equities, especially sort of long duration equities, like the sort of the more frothy, bubbly parts of the tech complex. And it's not great for things like gold, for example, which does not pay any kind of sort of income. And it is positive for the US dollar. So the real yields here very strong. And we can see this if we look at the TIP ETF, which measures the Treasury inflation protected securities. So you can see here we had a big gap down on Friday. And as you can see here, as the price goes down, it sees real yields rising. So this is the inverse to real yields. So you can see here that it's been going down, which is indicating that real yields are going up. Now, if we also look then at the well, that's another way of looking at it, but I want to look then at the term premium as well. You can see that last couple of days has gone down, but basically the term premium has been going up, and that's essentially the extra sort of premium which investors demand. Let's say, for example, you have a 3-month bond, a 3-month T-bill or a 1-month T-bill, and you just keep on rolling it over for 10 years. That would give you a certain amount of sort of yield for the 10-year. But what the term premium is telling you is the extra risk value, the extra premium investors are demanding, rather than just rolling over, let's say, 1 or 3-month bills. And you can see here that it's now at about 70, 75 basis points, or 70, 72 basis points. And that's been going up over the last sort of 4, 5, 6 weeks. And that's telling you that markets are concerned about too much sort of debt issuance. They're concerned about geopolitical risk. They're concerned about inflation worries. And that's why, as that term premium going up, that's also showing you the stress in the bond market. So all that to say that we've got a bond market here which is under stress. And another way of looking at that is not only the long end, is looking at the front end. So if we look at the front end, let's just look at, let's say, the SOFR market, and just to give you a sense of the curve here and what the Fed's been sort of doing. You can see here that if we go back to this is the SOFR curve. So this is the implicit sort of yield on the SOFR curve, and this is the change. Now, what is the change? This is from the blue here is from the 27th of February, so just before the Iran war sort of broke out. And basically what you can see here is that the market at that point had been pricing in sort of cuts and the diminishing sort of Fed funds rate going all the way down to 2027, and we were going. The market had been pricing in from a rate of around about sort of 3.65s down to under 3, so about 2.5 to 3 cuts, something like that. And then you can see that since then, since the war has started, look at the curve. The curve of the SOFR implicit yield has gone from rather than sort of negative, it's actually gone positive now. So the market is now basically saying, hey, forget all these cuts and a lower overnight rate. Basically, the market is saying that we're, implicitly going to be having sort of potentially cuts happening. And sometime sort of at the end of 26, beginning of 27 is the biggest change. And you can see this on the Bloomberg function, the WIRP function, world interest rate probability. And you see here on the right the number of hikes or cuts. Now that was cuts which were priced in, but you can now see that again the market is pricing in at the maximum, which is the middle of the summer of 2027. So basically, a year from now, the market's actually pricing more than one hike. So about 1.3 hikes. So what's that? That's about 30 basis points or so. So now we have an implicit bias towards the upside, and this is going to be very interesting this week because Kevin Walsh has officially taken over. This is his first sort of official week on the job, and it's going to be very, very interesting to see his comments. I'm not sure that he's scheduled to speak this week, but this is the situation he's at. And if you actually just look here, again, just a couple of other things to look at is just the overall curve of the US. And again, you can see from 1 week, even just in the last week, which is a week ago, is this yellow number here, and where we're at now is the green. And you can just see here just the amount of basis points. We had a huge rip since the last week, especially in the 2, 3, 4, 5, 6, 7. Look at this area here, but actually all across the curve, really, even going all the way on the right here to the 30-year. You can see that yields have gone up 10, 15, 20 basis points in 1 week. This is a bit of a bond tantrum here, and this is a huge potential problem for sort of risk assets. And another way of looking at that is just to see what the market is telling us. So what we have here is the effective Fed funds rate, which is this sort of turquoisey thing here. And you can see that this is, and the other line here is the 2-year yield, which is the front end, which is more directly controlled by the Fed. So what is this telling us? If we go all the way coming out to COVID, you can see that coming out to COVID, the effective Fed funds rate was essentially at zero. And you can see that the 2-year yield was in accord with it, was in agreement with it. But then as inflation started kicking in, if we go into sort of the latter half of 2000, if we go into 2021, you can see here that the 2-year yield started to rise very, very significantly. And you can see here that for many months, the Fed did nothing. Remember the famous Powell saying that, everything's transitory, everything's transitory. Now the Fed, so what we had a certain point here where you can see that the spread between the 2-year yield over the effective Fed funds rate, it got to a certain point at over 200, 250 basis points. And that was the market screaming at the Fed saying, inflation is a problem, you're behind the curve, you need to start raising interest rates. And this is the gap. And then the Fed, as we saw, they started to raise interest rates very, very dramatically all the way out into September, December of 2022. And eventually, it's only at the end of 2022 that they sort of got that to an equilibrium point, and then eventually they started getting restrictive. And you can see here that in this whole period of 2023, even almost to 2025, you see here that the effective Fed funds rate in the turquoise, in the red here, was actually above the 2-year yield. So the market sort of calmed down. The 2-year yield here, you can see, kind of stabilized, and the effective Fed funds rate went above that and was restrictive and tried to really hammer down inflation. And indeed, inflation did come down a little bit. But what's disturbing and interesting is that look where we now are at. That sort of restrictiveness has now diminished until the point that we're now getting back into green territory. So what does green territory now mean? That now means that the 2-year yield, you see, remember the white line here, is now above the effective Fed funds rate. So is this the market now communicating, much as we had back in 2021, 2022, the market is now communicating with the Fed and saying, hey, rates are not tight enough. You will have to start raising interest rates. And that's why we're starting to see, and that's why the chart is telling us. And that's why for Kevin Walsh, it's going to be very, very difficult for him to obviously to cut interest rates. But the market is now sort of pricing in, basically that the Fed will have to hike. And you can see that here, this is all the SOFR contracts. So we've got all the way going from December 2026 in the blue all the way out to March 2027. And you can see here that the price has gone down. And maybe I'll show that just on a trading view chart, not on the Bloomberg there. I'll go to this one here, and I just want to show you here, guys, just what's going on. So if we look at I do want to look at the price here. So obviously this is the inverse of yields, which are going up. So we can see that over the last sort of 6-10 days or so on the September 26th contract, it's gone down a lot. But just look the further out we go. So there's now December 26th. You see it's more dramatic. Then you go out to March 27, June 27, September 27. And then December 27, you can just see how much more the curve is really steepening there. And the curve is really telling you the market is screaming at basically communicating the fact that the Fed will need to hike over the next year or so. And therefore, what does that all mean? That all means that for someone like Kevin Walsh, who's got sort of higher real yields, higher inflation expectations, higher SOFR contracts and whatever, this is putting a lot of pressure on the equities. And you see here that the equities are starting to roll over. And really the equities were basically, as I was saying last week, essentially saying, okay, we have a bit of an energy shock. It's not fun, but probably it's got to be resolved in the next month or two, and we'll all get back to, basically absorbing all of that energy shock and that inflation shock with the AI capex story. And we know that the capex story is real in AI. We know that earnings are good, and et cetera, et cetera. And that's essentially been the narrative that the equity market has adopted. You see here the ES, and you see here that NASDAQ obviously ripping much higher, but giving back a little bit on Friday. So really now what the market has to do is to essentially say, hey, the bond yields are ripping higher. The bond yields are saying that the Fed needs to hike. The bond yields are saying that there's too much fiscal dominance. There's too much bond issuance. There's too much spending. The budgets are too big. We need more fiscal discipline, and that inflation is a problem. That's what the bond yields are saying. So really, the equity markets have sort of responded to their cousins in the bond market over the last month or two since the duration of the war. And just keep in mind that this war began in March, so it went down a little bit, but essentially it's been going up. So the real question which we have to look at today is whether this equity sell-off, which still hasn't caused a huge amount of technical damage, just on the very shorter term fib here on the ES, you can see here that we're just sort of kissing the first 38% fib retracement here down at about 7,363. And we've had a little bit of a bounce, approximately from that. NASDAQ, similar kind of situation here, although you can see we haven't even got down there. So technically, this is not a huge sort of pullback. And really, what's going to determine whether this sort of turns into a deeper pullback here, you can see the first fib levels here. You can see the 20, 50, 100, 200-day moving average, and you can see a much deeper fib pullback going all the way from down here. So let me just get rid of this, the measured move, that which we didn't quite get there. We got there on the NASDAQ, but not on the ES. So are we going to get down to these levels? Of course, we have NVIDIA. So if we just look at NVIDIA, we have the NVIDIA sort of earnings this Wednesday, and that's going to be a key component. It's expected to be good. I'll talk about that later in the week. But you can see NVIDIA also is doing had been doing very, very well. It came off on Friday a little bit. It looks as though it achieved its sort of Fibonacci extension here, the measured move. You see it got to one of the key levels in the Fibonacci levels there. So just taking a bit of a pause. Now, is this just going to be a bit of a pause, or are we going to see a much bigger sell-off in the the S&P 500 and even the NASDAQ? It really, what has to happen is that the market needs to look at the bond market and say, those guys overreacted. Actually, oil will be contained. There will be some demand destruction. There will be a deal, and life will go on. And the AI capex sort of story will be enough, will be strong enough to absorb that. But again, it's a very thin market, and this is maybe a potential issue here. If we look at the equal weight, you can see that's been selling off and heavy for 4 or 5 days. We look at the Mag 7; it's been super strong, but again, the Friday sell-off. Now it's all about the semiconductors. We have to look at the semiconductors, and we also have to look at DRAM is a good one, which is much more about the memory chips, much more about Samsung, SK Hynix, and whatnot. And talking about Samsung, keep in mind that there's a bit of a problem just because there's potentially going to be a big strike starting on May the 21st, so in 3 or 4 days, 45,000 workers in Samsung over in Korea basically going on strike. And really what we have to see here is whether that's going to be resolved, because that's putting a dent in the Kospi. You see the Kospi sold off quite a lot. It's subsequently sort of stabilized. But let's keep an eye on Samsung and DRAM. just in terms of that Samsung strike, because if the SMH, so the semiconductor starts to fall off, if DRAM starts to fall off, if the COSPI starts to fall off, that could be the canary in the coal line, saying that this whole story, this very sort of narrow story of strength in semiconductors, strength in the memory and the chip makers and whatnot, if that's only a single sort of sector story, has been strong enough to offset this inflationary shock and the energy shock. If that story in the equities is not strong enough to offset the energy and inflation shock, then we could be in for some problems. Okay, going on a bit too long here, guys. So I'm just going to wrap it up pretty quickly here, but I just wanted to put that all into context. And just another quick thing I just want to have a look at here is if we actually look at the, I just want to have a quick look more into the energy market here. So if we look at the front contract, which is now July in oil, look at that. It's actually at highs. It's actually at highs. So what's interesting here is that if you look at the CL1, so the continuous contract here, it looks as though it's strong, but it's not at the highs. But if you look here at just at the further out contracts, so just when you look at the shape of the curve and whether the market is pricing in a quick sort of cessation of hostilities. If you look at the July contract, it actually was rejected at its highs, but it is at the highs. If we then let's go forward a few months to September, you can see, look at that. So what is this telling us? And then if you look at December, you can see they all made new contract highs. Why is that important? What that is telling us is that the curve is still in a backwardated shape. So the front prices, we can see there's $102 here for July, and we can see for September it's $93, and for December it's $84. So the curve is still in backwardation. But what's happening is that the market is still happy to price in sort of higher prices for the longer term contracts. So we're talking the September or the December contracts, or even if we look at March 27, you can see they're all making new highs. So that is telling me that the market is starting to get a little bit more nervous about the duration of this sort of supply shock. The market is not saying, hey, this is all going to be over in a few weeks. It's all good. The market is saying even in the September, December, and March 2027 oil contracts that these prices need to remain relative to their earlier sort of price action, that they need to remain sort of more elevated. And that is telling me that the market is starting to price in an extended supply shock, an extended energy shock. And that's what's pushing up the inflation expectations. And that's what's pushing up the bond yields, apart from also the fiscal problems, too much of fiscal issuance. And that increasingly, in my humble opinion, is going to put more and more pressure on the equity market. And that's something we have to be looking out for this week, basically. Obviously, NVIDIA, we also have the FOMC minutes on Wednesday, which is the last FOMC minutes at which Powell was the Fed chair. That's expected to retain its hawkish sort of bias. So what is that basically giving us? That's giving us high yields. It's giving us high energy prices. It's also giving us a strong US dollar, which has just calmed down a little bit. We had just a little bit of a stabilization. But the real question for the next day or two is going to be, is this stabilization in the bond yields and in the US dollar and in energy? Is this just a temporary little lull and we're going to get another push higher? Or not? That's really the fundamental things to be looking at. Will the stabilization continue this morning? And then we can also see, let's say, something like the gold. You can see that gold coming off, again, stabilizing, but gold not liking these high real yields. Silver also coming off quite a bit and just sort of stabilizing around the 200-day moving average here. Copper also coming off and just hitting that sort of pretty key resistance level at about 6.2. And what is interesting in copper, just keep in mind, just looking at the VWAP, is that a lot of the big sort of a lot of this upward price pressure was caused by the VWAP being about 6.3. So the average price was about 6.3. And so a lot of the people who bought at that average price are sort of underwater now. And that's one of the reasons that copper may be having a little bit of a sell-off. We also had industrial production numbers overnight from China, which was lower than expected. And that's not great for sentiment for copper. So copper having a bit of a pause here, but really the metals, the industrial and the precious, especially the precious metals, not loving these higher real yields and not loving this stronger US dollar. Okay, guys, I want to leave it there just for the moment. One thing I would just finally finish with, BTC, disappointing price action, basically stalled out at this sort of confluence, more or less, of the 200-day EMA, which is also this fib level here at about 83,500, which is the 61.8 fib retracement here. So pretty key here. We've got the 50 and the 100-day confluence. The buy is going to come in here, but really, what I would say is that for the BTC bulls, it would be interesting, and I would say perhaps even necessary. Let's just look at what needs to happen here. This is getting around towards a 38% fib retracement here. So this is an interesting place for the bulls to come in. You can also see a recent low down here at about 75,500. So 75,500 is pretty key level. It's a 38% fib retrace down here. It's also the confluence of the 50 and the 100-day moving average here. Really, the bulls need to keep it above that. Certainly, they need to keep it above here, which is the bottom of the trend, and also the 61.8 fib retrace from this most recent price action. Anything below here is going to be very, very, very concerning. The bulls will need to step in basically in this zone from a technical perspective here to drive the price action higher and just stabilize things. So that's going to be an interesting one to be looking out for today as well. Okay, guys, I want to leave it there. So as I say, let's keep an eye on the 10-year and the 30, actually all of the bond yields, to see if they stabilize, maybe even go up a little bit, or whether this overnight price action is just pajama trading. It means nothing. And actually, whether the yields start to sort of rise high and the bonds sell off. And that, of course, will have implications for gold and for the US dollar. And of course, want to keep an eye on oil prices and the headlines, anything coming out of the Mideast. Okay, thanks very much. Take care. Have a great day, and I'll be back tomorrow with the macro snapshot. Thank you.